Okay, so picture this, right? You have this high-flying Merrill Lynch executive, super wealthy, like thinks nothing of smashing a $500 lamp. And then to add insult to injury, he just throws $5,000 at the manager.
Oh, wow.
Years later, the same executive files for bankruptcy.
Oh, my goodness.
Talk about a turn of events. Now, on the flip side, you have this Vermont janitor,
Okay.
Ronald Reed. This guy lived frugally, invested his savings very diligently. And guess what? When he died,
Yeah.
he left an $8 million fortune.
No way.
I know, right? It's crazy.
That's amazing.
But it really highlights this powerful truth about money.
Yeah.
Financial success, it isn't always about intelligence or, a fancy education. It's often more about our behavior and our mindset. What do you think?
It's such a fascinating paradox because, people, we just kind of assume that to be successful with money, you need this like super high IQ
Right.
and these really sophisticated strategies.
Yeah, for sure.
But Morgan Housel, in his book, The Psychology of Money,
Yes.
he makes this really compelling argument that it's actually our deep-seated beliefs
Okay.
and behaviors that really drive our financial outcomes.
It's so true. And that is exactly what we are diving into today.
Awesome. I'm excited.
We've got Housel's book, The Psychology of Money, as our guide. And we're going to explore how things like emotions, biases, and even personal experiences shape our financial decisions,
Yeah.
often in ways we don't even realize.
It's kind of scary when you think about it like that,
Yeah, it is.
We're not always in control as much as we think we are.
Absolutely.
So, Housel, he kicks things off with this idea that our personal history, it's like a financial lens,
Oh, interesting.
It shapes how we view things like money and risk.
Okay.
Or each develop this unique perspective, like based on, how we grew up, the economic environment we've lived through, even like seemingly insignificant personal encounters with money can make a big difference.
That makes sense. It's kind of like those optical illusions, right?
Yes, exactly.
Where you have the same image, but people see totally different things.
It's the same image.
One person might see a vase, another person sees two faces.
It's wild.
Our personal history, it's shaping what we see when it comes to our finances.
Exactly. So like, let's say someone who they came of age during that high inflation of the 1970s. You remember that?
Oh, yeah.
They might be really wary of bonds because they remember how inflation just ate away at the value.
Yeah, makes sense.
But then you have someone who experienced the low inflation of the 1990s. They might view bonds as these safe havens. You see, it's not just about logic.
Yeah.
It's about the emotional weight
Yeah.
of those past experiences.
Wow. So you're saying that where I was born and when I grew up could actually have a bigger impact on my risk tolerance than like how much I know about investing or my education.
That's exactly what I'm saying.
Whoa. That's pretty mind-blowing.
And you know what? There's actually research to back this up. These economists, Ulrich Malmendia and Stefan Nagel, they studied 50 years of data.
Wow.
And what they found was that people's willingness to take risks was way more influenced by their personal history than their intelligence or their education.
That's wild. Okay. So our past shapes how we see money. Got it. What else does Housel talk about?
Well, he emphasizes that both luck and risk are super powerful forces in our financial lives.
Okay.
Often more than we'd like to admit.
This is where things get really interesting, right? Because he compares the journeys of Bill Gates
Oh, yeah.
and his equally brilliant friend, Kent Evans.
Okay.
Gates, we all know him. He co-founded Microsoft, became a tech titan.
Right.
But sadly, Evans died young in a climbing accident.
Oh, wow.
And it wasn't because he lacked talent or put in less effort than Gates.
Yeah.
It was just the unpredictable hand of fate.
So it was just bad luck.
It really was. So are you saying that even with all the talent and hard work in the world, sometimes luck just plays a bigger role than we want to admit?
Sometimes it really does.
It's a bit of a sobering thought.
It is.
But it can't all be about luck, right?
Of course not.
I mean, Bill Gates still had to build Microsoft.
Oh, absolutely. Skill and effort are essential. There's no doubt about that.
Yeah.
But I think it's important to be honest with ourselves, about the role of luck. Even someone like Bill Gross, the Bond King.
Oh, yeah.
He acknowledges this. Despite his incredible success, he admits a lot of it was due to a massive decline in interest rates during his career.
Okay.
And that's just a trend he couldn't have predicted or controlled.
Makes sense. It's like being a surfer, right?
Exactly.
You might be incredibly skilled, but if the waves aren't there, you're not going to catch a good ride.
Exactly. It doesn't matter how good you are. If the conditions aren't right,
Right.
you're not going to succeed.
Totally. So acknowledging the role of luck and risk, it just helps us be a little more humble about our successes.
I think so.
And a little more understanding of our setbacks, right?
Exactly.
That's a really good point. Okay, so we've talked about the influence of our personal history and the unpredictable roles of luck and risk. What else does Housel explore?
So he digs into this concept that's it's universal but also really elusive, this idea enough.
Enough.
As humans, we have this tendency to always want more.
It's true.
Even when we have what most people would consider enough.
This is something I struggle with, too. It's like, I think we've all felt that pull, that yearning for just a little bit more.
Yeah.
But that is more always better? I don't know.
That's the million-dollar question, right?
It is.
Also, he shares this fantastic anecdote about the author Joseph Heller.
I love Joseph Heller.
Right. He wrote Catch-22.
Oh, such a classic.
So Heller is at this party, right?
Okay.
And it's hosted by this billionaire hedge fund manager.
Okay.
And someone at the party makes this comment like, oh, this hedge fund manager makes more money in a day than you did from your entire book.
Ooh, shots fired.
Right.
What did he say? What did Heller say?
With perfect comedic timing, Heller goes, yes, but I have something he will never have enough.
Oh, man. That is the perfect comeback. It's so true, though. Sometimes the pursuit of more actually robs us of the satisfaction and contentment that comes with, appreciating what we already have.
Yes, and it's so easy to get caught up in that, like the comparison game, the keeping up with the Joneses.
It really is.
It's a never-ending cycle.
It's true. So how do we break free? How do we find that sense of enough?
That's a question we'll continue to explore as we go deeper into Housel's ideas.
Okay, I'm ready for more. Let's keep going.
You know what's interesting? It's like how much our financial behaviors, even today, are shaped by all these historical forces, even those that happened like way before we were born.
It's so true. It's like those ripples in a pond, right?
Yeah.
They just keep spreading outward long after the stone's been thrown in.
I like that analogy.
Thanks.
Yeah.
So what historical events, does Housel highlight as having a particularly strong impact on our financial psychology, the ones we're dealing with now?
Well, he takes us back to like a pivotal moment, the end of World War II.
Okay, 1945.
Yeah, exactly. It's 1945. The war is over. The U.S. comes out as this global superpower.
Right.
But even amidst all the victory celebrations, there's like this underlying anxiety.
Yeah, I could see that. I mean, millions of soldiers are returning home,
Right.
eager to start families and build the lives they had put on hold during the war.
Yeah, and after going through the Great Depression and then a war, the last thing anyone wanted was another economic downturn.
For sure. So what happened? What did policymakers do?
So they knew they had to keep the economy, humming along, right?
Yeah.
To prevent mass unemployment and, social unrest.
Right, of course.
So they came up with this plan. And it was well-intentioned,
Okay.
but it ended up like inadvertently shaping the financial habits and expectations of generations to come.
Oh, wow, really? Okay, I'm intrigued. Tell me more about this plan.
One of their primary tools was something that has become like a defining feature of our modern economy.
Okay.
Low interest rates.
Wait a minute. So you're telling me this wasn't just a coincidence of economic conditions at the time? It was an actual strategy.
Yeah, totally. It was a deliberate move to help shape the economy. In 1942, the Federal Reserve, they worked with the government, right?
Okay.
And they announced that they were going to keep short-term interest rates at, get this, 0.38%.
Wow. 0.38%. That's incredibly low.
Super low. And it was all to help finance the war effort.
Okay, that makes sense. But how long did they keep them that low?
So those rates, they didn't budge for the next 7 years. 3-month Treasury yields remained below 2% until like the mid-1950s.
Wow. So for almost an entire decade, borrowing money was just super cheap.
Basically, yeah. So what impact did this have on people's behavior and like the overall economy?
Yeah, what happened?
It was like they opened the floodgates. Returning GIs, they were eager to like buy homes, cars, all those consumer goods that they had missed out on during the war.
Right.
And suddenly they had access to credit at these like unbelievably favorable terms.
Wow.
This was the birth of like the American consumer as we know it today.
So it sounds like policymakers intentionally encouraged people to spend to jumpstart the economy.
You got it. They understood that encouraging consumption was like the key to prevent going back to another depression.
It makes sense.
Low interest rates, they made it easier for Americans to borrow money, and, it fueled economic growth.
It does sound like a recipe for a spending spree, but did it work?
It totally worked.
Okay.
The post-war years, they saw this unprecedented economic boom. Think about it. Between 1945 and 1949, something like 21 million cars were sold. And by 1955, another 37 million rolled off the assembly lines.
Wow.
And it wasn't just cars, home construction that boomed as well.
Right, because millions of new houses were built in the decade after the war. This was the era of suburban sprawl, right?
Exactly.
That classic American dream. A house with a white picket fence, shiny new car on the driveway.
Yep. And that dream was fueled, in large part, by this readily available credit.
It's amazing to think that the seeds of our modern kind of debt-driven economy were sown way back then. But was it seen as a problem back then? Or was it just like, woohoo, look at us go?
Oh, it was definitely seen as a good thing, like a sign of progress,
Okay.
Americans were buying homes, they were buying cars, appliances, all this stuff created jobs and like fueled economic growth. It was seen as this, virtuous cycle.
So it sounds like there was this collective optimism, like everyone believed America was on the right track.
Yeah, there was this powerful narrative that took hold, like this idea that consumption equaled progress and prosperity. But that narrative, while rooted in genuine economic gains of the post-war era, it eventually collided with a changing economic landscape.
So when did that happen? When did things start to, like, unravel? What were the cracks in this seemingly perfect picture?
Well, as we move into the 1970s, you have a bunch of events that start to like challenge the post-war economic order, right?
Oh,
One of the big ones is the 1973 oil embargo by OPEC that sent shockwaves through the global economy.
the oil crisis. I remember my parents talking about this. The gas lines, the crazy prices.
It was wild. Energy prices went through the roof, leading to like runaway inflation
Yeah.
and a recession that gripped a lot of the developed world.
It was a real wake-up call for sure.
It was. And, it wasn't just the oil crisis. The rise of globalization also played a major role.
Okay, how so?
Well, like countries like Japan and later China, they came out as these like economic powerhouses,
Yeah.
challenging America's industrial dominance.
Right, which must have put a lot of pressure on American manufacturing jobs, I'm guessing.
It did, yeah, leading to job losses and a decline in the bargaining power of workers.
Oh.
And this happened at the same time as this shift in the American workforce. More and more people were moving into these like service sector jobs.
Right, and those often paid less and offered fewer benefits than those like old manufacturing jobs.
Exactly. So this is where you start to see the roots of income inequality really taking hold.
So even with all these changes happening, the American dream narrative persisted. Like, people still believed in it.
They did, and that's what makes this period so interesting. People were still clinging to the idea that, hard work, good education equals a comfortable middle-class lifestyle, even though the economic landscape was shifting right beneath their feet.
It's like driving down a road that's no longer there. Like you're following the directions, but you're not getting where you want to go.
Perfect analogy.
It really is.
This disconnect between, like, expectations and reality, it had huge consequences. It fueled this debt-driven consumption binge, and made those inequalities even worse.
So how did it play out? Like, what happened next in this whole saga of the American consumer?
Well, in the 1980s, under Reagan, we see this narrative like repackaged and resold.
Reaganomics, tax cuts, deregulation, and the whole trickle-down theory.
Got it. Reagan's policies, supply-side economic, trickle-down economics, whatever you want to call it, it focused on reducing the role of government, right?
Right.
And like unleashing the power of the free market.
Okay, so it was a big departure from those post-war policies we talked about. But did it work? Did it benefit everyone?
The economy did grow a lot in the 80s, but that growth, it wasn't really evenly distributed. The gap between the rich and the poor got a lot bigger.
Right, because the top 1% saw their incomes explode, while the middle class kind of stagnated and the poor fell even further behind. This is also that era of, like, Wall Street greed, right?
Oh, yeah.
It's like greed is good was the mentality.
Yeah, it was a time of big change for sure. The financial industry was transformed by deregulation, all these new financial instruments, profits were the priority, and a small number of people made like a ton of money.
But how did this impact the everyday American? Were they part of this wave of wealth and prosperity?
Well, as the rich got richer, their lifestyles got more and more extravagant, Bigger houses, fancy cars, private schools for their kids, vacations in exotic places. It created a new kind of pressure for the middle class.
Like they had to keep up with the Joneses, even if it meant, taking on more and more debt.
Exactly. It's like the American dream got redefined, It was less about financial security and upward mobility, and it became more about like chasing material possessions.
And social status, yeah, totally.
The gap between what people wanted and what they could actually afford, it widened a lot during this time.
It was driven by a lot of things, I guess. Easy access to credit, aggressive marketing, by the financial industry. And then you have the media glamorizing wealth and consumption.
Yeah, all of that contributed. It's like this collective delusion took hold. People were convinced they could have it all, even if it meant, living way beyond their means.
Wow. So this brings us to the 2008 financial crisis. How did this whole narrative of keeping up with the Joneses and easy credit contribute to the housing bubble and ultimately the economic crash.
Well, you see, in the early 2000s, the American economy was doing well. Low interest rates, booming housing market.
Right.
But underneath it all, there was this really dangerous trend happening.
Okay, like what?
The financial industry was pumping out all these risky mortgages, often to people who couldn't afford them.
The subprime mortgages?
Yes.
I remember those.
With those low initial payments and adjustable rates, they seemed like a great deal.
Yeah, but it seems like a recipe for disaster waiting to happen.
And it was all fueled by this belief that owning a home was a guaranteed way to build wealth and security, a narrative that had been drilled into people's minds for years.
So everyone thought housing prices would just keep going up, up, up.
Exactly. People were willing to take on tons of debt to get a piece of the pie.
But it couldn't last forever. It had to burst at some point.
And it did, with some pretty bad consequences. Millions lost their home to foreclosure. The whole financial system nearly collapsed.
And the global economy was sent into the worst recession since the Great Depression.
Yeah, it was a stark reminder of how dangerous debt can be, how fragile the financial system is, and how powerful narratives can influence our decisions about money.
It's something we need to remember, especially as we try to, navigate all the complexities of finance in the 21st century.
Absolutely. So how does all of this historical context we've talked about connect to our financial lives today? From the post-war boom to the housing bubble and everything in between.
Yeah, how can understanding these past trends help us make better decisions in the present?
That's a great question, and it's a perfect segue into the next part of our deep dive, where we're going to explore some of the challenges we're facing now.
Okay, great.
Things like rising income inequality, the student debt crisis, and that growing disconnect between the reality of many Americans' finances and that, persistent narrative of the American dream.
I'm ready to dive in. Let's do it. It's weird, right? It feels like we're living in this time of contradictions. Like on one hand, you hear about, low unemployment, fortune wages.
Yeah.
But on the other hand, there's this overwhelming sense of financial anxiety out there.
Yeah, I know what you mean.
It's like we're being pulled in two different directions.
You've hit the nail on the head. It's like, even though some of the economic indicators look good on paper,
Right.
the reality for a lot of people is it's just different,
Yeah.
We're still dealing with all that fallout from those long-term trends we talked about, like rising income inequality.
Right.
And wages that just haven't really kept pace for a big chunk of the population. So it's created the situation where even when the economy is supposedly doing well, a lot of people just feel like they're struggling to stay afloat.
So it's like even if the overall pie is getting bigger, the slices aren't being divided up fairly.
Yeah, exactly.
Got it.
And that has a huge impact on people's psychology, and the decisions they make about money.
In what way?
Well, when you're constantly feeling like you're falling behind, it can be really discouraging.
Yeah, I bet.
It can lead to this sense of hopelessness.
Right.
And even make you feel like the system is just rigged against you.
Oh, absolutely. It's like running a race where the finish line just keeps getting farther and farther away.
That's a great way to put it.
Thanks.
And, for younger generations, people just starting out in their careers,
Yeah.
this feeling is often made worse by the student debt crisis.
Ugh, don't even get me started on student debt.
It's a huge problem.
It really is. I know so many people who are just buried under these mountains of student loans.
Yeah.
It feels like the defining challenge for millennials and Gen Z,
It is, and it has ripple effects everywhere.
Yeah,
I mean, the cost of college has just exploded.
it really has.
So a lot of students, they have no choice but to take on massive amounts of debt.
Right.
And these loans with those high interest rates, they can delay or even derail like major life events. Things like buying a house, getting married, starting a family. All that stuff gets pushed back.
It's true. It's like starting your adult life with this giant weight around your neck.
Exactly. And it's not even just the student debt. It's that they're entering a job market that's totally different now,
How so?
Well, think about it. It's been completely transformed by automation, globalization, the whole gig economy thing.
Yeah.
It's much more uncertain for them than it was for older generations.
For sure.
Like often lower pay, fewer benefits, and way less job security.
So, wow, that kind of paints a bleak picture.
Yeah.
So, given all these challenges, how do we reconcile this? Like this disconnect between the reality so many are facing, and that very persistent narrative of the American dream. Is it even attainable anymore? Or is it just an illusion at this point?
That's the big question, isn't it?
It is.
And the answer, it's complicated. There's no easy fix. Some people think we should just stick with the policies that have gotten us to this point, hoping that eventually trickle-down economics will save the day. But for many people, that just feels like an empty promise.
Yeah, especially after years of struggling, and seeing
Yeah.
little to no improvement.
Exactly.
So what are some of the alternatives? Like, what else can we do?
Well, there's this growing movement that supports policies that directly tackle income inequality.
Okay, like what kinds of policies?
Things like, progressive taxation, where the wealthy pay a higher percentage,
Okay,
investing in education, infrastructure, and making sure we have strong social safety nets.
makes sense.
It's about creating a system that's fairer for everyone,
Yep.
where people have a real chance to get ahead, regardless of their background.
Absolutely. But these are like big systemic issues.
Right.
What about on a personal level? What can individuals do to, to deal with this crazy financial landscape and maybe build a sense of security and well-being?
That's where the stuff Housel talks about in his book becomes really helpful.
Okay, good.
He reminds us that being successful with money, it's not just about crunching numbers.
Right.
It's about understanding our own psychology, developing healthy habits around money, and making financial decisions that are aligned with our values and what we want in the long run.
So it's about taking control of our finances, even if we can't control the bigger things happening in the economy.
Exactly. We might not be able to control everything, but we can control how we react to it,
Yeah.
And one of the most important things we can do is start to recognize the narratives that are influencing our financial decisions.
Okay. Interesting.
A lot of these narratives, we inherit them, right? From
Mhm.
our families, our culture, the media we consume.
Totally.
And we just accept them without really thinking about them.
True.
But sometimes those narratives, even if they were true once, they become outdated or even hold us back.
It's like wearing a pair of shoes that used to fit perfectly,
Yes,
but now they just pinch your feet.
exactly.
You have to be willing to try on different sizes and styles to find something that works better.
Love that analogy. We need to be more critical,
Yeah.
especially when it comes to money. Don't just blindly follow what everyone else is doing.
Okay, so how can we actually challenge those narratives? Like, how do we start to develop a healthier view of money?
Housel has some great tips.
I'm all ears.
First, he's really big on saving, even if it's just a small amount.
Okay.
It's not about depriving yourself. It's about building that cushion,
Right.
like a safety net that can help you if unexpected things happen. And it gives you more options and freedom later down the road.
It's like having an emergency fund, not just for when your car breaks down,
Yeah,
but for, life itself. It's about peace of mind.
totally. He also says, and I love this, less ego usually means more wealth. It's not about keeping up with the Joneses. It's not about impressing other people with material things.
Right.
Real wealth is about having enough to live a life that's true to you.
Yeah, like spending time with loved ones,
Exactly.
pursuing your passions, having the freedom to make choices without always stressing about money.
Yes, it's about defining success on your own terms.
I love that. Okay, what else?
Another important point he makes is you got to become okay with things going wrong sometimes.
Oh, yeah,
Investing always has some risk,
for sure.
and there will be moments when, we mess up or things don't go according to plan.
Of course.
The key is to not let those setbacks completely derail us.
It's about learning from those mistakes.
Yeah, and keeping moving forward. It's like that quote, success is not final, failure is not fatal. It is the courage to continue that counts.
That's a good one.
Right. And finally, this is a big one. Housel reminds us that the best thing you can buy with money is control over your time.
Okay,
It's about using your resources to have more flexibility and freedom.
I like that.
Whether that's, being able to take a year off from work, or maybe start your own business, spend more time with your family, or just do things you enjoy without being preoccupied with money.
Yeah, it's about shifting the focus from, building up a huge pile of cash to living a more meaningful life.
Exactly. So the psychology of money, it really highlights that financial well-being. It's not just about, having a lot of money in the bank.
Right.
It's about developing a healthy relationship with money,
I agree.
one that makes you happy, and helps you live a good life.
This has been a great deep dive. I feel like I've learned a lot about money. Not just as a way to get things, but as a reflection of our values and beliefs and what we want in life.
Yeah, it's been great talking about this.
It really have. So any final thoughts for our listeners before we wrap up?
I would just say check out The Psychology of Money by Morgan Housel if you haven't already. It's a really thought-provoking book.
It is.
It helps you understand people, and why we do the things we do with money. And it'll equip you to make better choices about your finances.
Absolutely.
I would also encourage you to, ask yourself, what narratives are driving my financial decisions?
Yeah, that's a good question.
Am I sacrificing something I don't need to? What can I do right now to make sure my choices are aligned with the life I really want?
That's a good one too. Remember, everyone, financial well-being is a journey. It's a process of learning and adapting and making choices that are right for you.
Couldn't have said it better myself.
Awesome. Well, thank you so much for taking us on this deep dive. It's been incredibly insightful.
My pleasure.
And to our listeners, thank you so much for joining us. We hope you found this exploration of the psychology of money as interesting and as valuable as we did. Until next time, keep learning, keep asking questions, and keep working towards a fulfilling life. We'll see you on the next deep dive into ideas that matter.
See you then. TEAO.